Hydrogen's push toward global trade has always promised something bigger than decarbonizing domestic industry. From the moment policymakers began projecting multi-billion-dollar export corridors, hydrogen became as much a story of logistics and geopolitics as a story of electrolysis, renewable electricity, or carbon capture. Producers in the Middle East, Australia, the United States, and parts of North Africa imagine exporting renewable molecules at volume. Importers in Europe, Japan, and South Korea imagine securing foreign supply to decarbonize steel, ammonia, chemicals, refining, and power sectors. Between those two ambitions sit ports and pipelines, two infrastructures that do not move hydrogen the same way and do not shape economics the same way, but together quietly determine whether exports become a real commodity market or remain a series of political demonstrations and bilateral agreements. Ports represent optionality, maritime logistics, conversion chemistry, and global buyers. Pipelines represent continental corridors, industrial clusters, allocation certainty, and price stability. One favors producers and traders, the other favors buyers and regulators. When analysts ask who controls hydrogen export economics, the answer rarely lies at the electrolyzer, it lies at the gateway. To understand why, it helps to strip hydrogen of the narrative that it is a new commodity. Hydrogen behaves more like an industrial gas than like oil. It is expensive to compress, expensive to liquefy, sensitive to distance, and awkward to store. Unlike LNG, it lacks a mature global trading market. Unlike ammonia, it is not easily shipped without conversion penalties. And unlike pipeline natural gas, its delivered cost increases quickly over distance, unless volumes are high and continuous. For hydrogen exporters who imagine selling molecules across oceans, ports decide whether conversion losses, storage, bunkering, shipping rates, insurance, and reconversion can be tolerated in a financial model. For hydrogen importers who imagine supplying industrial clusters at scale, pipelines decide whether demand synchronization, throughput certainty, standards, and long-term offtake agreements can be aligned. Neither mode wins universally, neither mode loses universally. The key is context. Different contexts emerge when you project hydrogen markets forward in time. At the 2030 horizon, the first serious test is not global commoditization, but feasibility. Can projects reach final investment decision? Can electrolyzers be synchronized with power markets? Can exporters demonstrate credible offtake? Can buyers take operational delivery? Ports and pipelines matter because feasibility depends on utilization, not ambition. If export terminals or pipeline repurposing timelines slip, utilization risk increases. If standardization lags, certification and custody transfer become bottlenecks. A project that cannot demonstrate utilization cannot achieve bankability, regardless of its electrolyzer price or renewable energy input cost. This is why hydrogen megaprojects increasingly model logistics before they model electrolyzer capacity. It is not the megawatts that determine viability, but where the molecules will land. At the 2035 horizon, the conversation shifts from feasibility to scaling. European steel, ammonia, and chemical plants expect to decarbonize feedstock by then. Japan and South Korea expect to run demonstration hydrogen power plants and integrate ammonia co-firing. Several Middle Eastern and Australian exporters expect to have maritime export corridors operating with carriers, terminals, and bunkering. Scaling introduces a new dynamic: competition between export gateways. Rotterdam, Hamburg, Antwerp, Fujairah, Busan, and other ports begin acting, not merely as infrastructure but as price discovery nodes. Whoever controls the gateway controls the marginal import price. This is not a speculative scenario. LNG markets evolve the same way. Oil markets evolve the same way. Commodities do not become global when production grows. They become global when gateways set benchmarks. Pipeline corridors evolve differently. They do not create gateways, they create allocation stability. Continental hydrogen backbones are being discussed and designed not to import hydrogen from producers, but to deliver hydrogen within industrial hubs. They connect steel plants to ammonia plants to refineries to chemical parks. They do not connect Qatar to Germany or Australia to Japan. They connect demand clusters that already exist. This reflects the fundamental difference between maritime trade and pipeline trade. Maritime trade connects supply to market. Pipeline trade connects buyers to other buyers. Maritime trade introduces optionality. Pipeline trade introduces certainty. Optionality benefits producers and traders. Certainty benefits industrial buyers and regulators. The economics reinforce this divergence. Pipelines excel at continental distances when volumes are high and continuous. The cost per kilogram declines with scale, and repurposing natural gas pipelines can reduce capex dramatically relative to new construction. Ports excel when distances exceed pipeline economics, or when buyers are geographically fragmented. Shipping can reach multiple markets. Pipelines cannot. But shipping hydrogen directly is costly due to low volumetric energy density and boil-off constraints, so exporters increasingly prefer exporting ammonia, methanol, or synthetic fuels rather than pure hydrogen. Ammonia requires reconversion for some use cases, but not for others, and it fits cleanly into existing ports, shipping fleets, storage tanks, and safety standards. Methanol integrates into petrochemical and synthetic fuel value chains. These choices matter because every conversion and reconversion layer adds cost, and different molecules imply different end markets. By 2035, hydrogen exports may not even be hydrogen exports. They may be ammonia exports with hydrogen embedded inside them. This gives ports more leverage, not less. On the buyer side, the calculus reverses. Industrial buyers want predictable delivery, year-round utilization, and minimal supply chain risk. A hydrogen-fueled steel plant cannot idle because a carrier ship is delayed at anchorage. A fertilizer plant cannot halt production because reconversion systems are undergoing maintenance. For buyers, pipelines represent control. European industrial clusters recognize this and therefore invest in backbone frameworks. They are not building these networks for fun. They are building them because they do not want to rely entirely on maritime hydrogen or ammonia imports to feed their decarbonization schedules. Ports bring competition, but pipelines bring stability. At maturity, buyers typically prefer stability. This introduces a geopolitical asymmetry that shapes export economics long before any final investment decision is taken. Producers in the Middle East, United States, and Australia want to export across oceans. Buyers in Europe, Japan, and South Korea want to secure long-term supply at predictable delivered cost. Producers want optionality and leverage. Buyers want certainty and control. Ports grant optionality. Pipelines grant certainty. Traders arbitrate the gap. Regulators mediate the risk, and financial models suffer when either side dominates too much. If exporters hold too much leverage, delivered costs climb. If buyers hold too much leverage, utilization risk climbs. Hydrogen succeeds only when both succeed simultaneously. System stress makes these tensions more visible. Unlike oil or LNG, hydrogen has not yet been forced to survive pricing cycles, maritime disruptions, choke point tensions, or logistics backlogs. When it does, ports and pipelines will respond differently. Ports must navigate maritime insurance, carrier availability, bunkering rules, storage terminals, and conversion equipment. Pipelines must navigate permitting delays, land acquisition, repurposing debates, compressor upgrades, and regulatory oversight. Maritime pathways suffer from multi-party coordination complexity. Pipeline pathways suffer from multi-jurisdictional permitting complexity. Both are vulnerable but for different reasons, and these vulnerabilities dictate which actors accumulate control over hydrogen export economics. Industry professionals who work inside hydrogen development, consulting, or investment already understand this dynamic intuitively. Levelized cost of hydrogen matters only until molecules need to move. After that, delivered cost dominates. Delivered cost is shaped by infrastructure that developers do not control. This is why serious project analysis increasingly focuses on logistics, demand synchronization, and certification rather than pure production, capex or electrolyzer efficiency. To build or finance a hydrogen project, one must understand where the molecule is going, who will buy it, under what contractual structure, through which infrastructure, and at what utilization rate. This is where ports and pipelines quietly decide the fate of projects. For professionals who seek to understand hydrogen not as a storyline but as a system, platforms like H2Hub by Renewable Energy are emerging to guide analysis toward bankability rather than narratives. The platform examines hydrogen through the lenses that developers, consultants, and investors actually require: system bottlenecks, logistics constraints, cost thresholds, FID gating conditions, incentive stacking, risk allocation, and offtake design. Doing hydrogen properly involves modeling not just production costs, but utilization, transport modes, certification, storage behavior, and industrial end markets. The market does not reward ambition, it rewards feasibility. Execution tools matter as well. Financial model templates, feasibility frameworks, and project development checklists for green hydrogen, green ammonia, solar PV, geothermal pumped storage, biogas, and other renewable assets help practitioners move from concept to model to pitch deck to due diligence. The tools do not replace strategy or negotiation, but they accelerate the tasks that determine whether a project is credible enough for investors, off-takers, or policymakers to engage with. Hydrogen is too complex to evaluate casually. It demands structured modeling, structured assumptions, and structured risk framing. Returning to the central question of control loosens the narrative further. Ports do not control hydrogen export economics because they move molecules. They control economics because they mediate access to markets. Pipelines do not control economics because they ensure safety or capacity. They control economics because they mediate allocation within industrial clusters. If hydrogen becomes a truly global commodity by 2050, the price will not be set at the electrolyzer. It will be set at the gateway where molecules enter the market. Gateways belong to ports. If hydrogen remains a regional commodity, price will not be set at the terminal. It will be set at the corridor where industrial clusters balance supply and demand. Corridors belong to pipelines. Ports control intercontinental hydrogen. Pipelines control continental hydrogen. Traders control spreads. Regulators control certification. Buyers control utilization. Control is not universal. Control is conditional. Spatial context validates this conditionality. Europe cannot afford to wait for pipelines from MENA or Central Asia. It must import via ports. Japan and South Korea cannot be pipeline markets for exporters abroad. They must be maritime markets. The United States cannot justify maritime hydrogen exports unless buyers exist overseas. It must rely on domestic demand clusters and potentially future ammonia exports. Australia cannot become a pipeline exporter. It will be maritime by definition. The Middle East cannot pipeline into Europe under current geopolitical constraints and must rely on ports. Geography decides more than ambition. Temporal context matters as well. In 2030, feasibility and demonstration rule. In 2035, scaling and standardization rule. In 2050, commoditization and liquidity rule. Ports benefit more from commoditization because trading requires gateways. Pipelines benefit more from scaling because industrial buyers require certainty. System stress adds a third dimension. Maritime choke points, geopolitical corridors, and terminal standards decide the fate of ports. Permitting, repurposing, compressor upgrades, and storage caverns decide the fate of pipelines. Whichever mode resolves its bottlenecks faster accumulates more control sooner. Control does not go to whoever is cheapest, but to whoever can reliably deliver. In the end, hydrogen will not choose between ports and pipelines. It will choose both. Intercontinental flows will go to ports because shipping is the only viable mode. Continental flows will go to pipelines because buyers will require certainty. The competition will not be between modes, but between specific ports for gateway status and specific corridors for allocation status. Producers will compete for access to premium import terminals. Buyers will compete for secure supply corridors. Traders will arbitrate spreads between gateways and corridors. Regulators will ensure no mode develops unacceptable concentration risk. and investors will finance whichever mode aligns with industrial end markets and policy mandates. If hydrogen becomes a commodity, the actors who control gateways and corridors will control price formation. If hydrogen remains a regional feedstock, the actors who control allocation and certification will control price formation. Either way, control lies not at the electrolyzer but at the interface between production and demand. Ports and pipelines may seem like infrastructure choices, but they are actually instruments of economic power. Hydrogen's export future will be shaped not by who produces it, but by who allocates it.